Hi, this is Professor Karen Lin. Welcome to the Financial Accounting for Undergraduate Students. In this video, I'll be talking about debit and credit and journal entries. Let's get started. I'll start the lecture by the idea of accounting cycle. So to handle the multitude of daily transactions that a business generates, companies establish accounting systems, usually computerized, and follow a cycle. So accounting cycle starts with what we discussed in the previous video, analyzing each business transactions that would affect the accounting system. And then we want to record those transactions, and we would record them in the journal in the form of entries. I'll talk about what entries look like in the next few minutes. And then we'll post those to a ledger. A ledger is like a summary of the journals. And then we prepare something called the trial balance, helping us to decide whether we have done something wrong during the first 3 steps. And we do some adjustment if needed. And then we'll have preparing the financial statement, and we will close the income statement accounts. That ends our cycle, and we start again by analyzing each transaction in the next cycle. So accounting cycle basically means repeating those steps over a period of time. It could be a month, a quarter, or a year. Now typically firms choose monthly accounting cycle, which means they repeat the steps and close the accounts within a month. Alright, now let's talk about the journal entries for now. So let's go back to what we have done in a previous video. We have transaction analysis. Now still using the stock issuance example, Chipotle issued 100 shares of stocks, 1 cent par value, which goes to the common stock, and then 17 cents market value. The difference between 17 and 1 would be 16 cents as a premium that the stockholders pay. That goes to an account called additional paid-in capital. In the previous video, we talked about this transaction will increase cash, also increase common stock and APIC on the right-hand side of the equation, and the equation is equal after we record the transaction. Now to formally record this, now this is just analysis. To formally record this, we need something called journal entry. So journal entry is like what we did as human, right? As a person, rather than a company. Now we keep daily journals. For example, when we are in primary school, our school teachers ask us to keep a journal for our daily activities. So we would basically write down, for example, I issue new stocks today, blah, blah, blah. Then it's very long and not professional. So what accountants do is that other than this transaction analysis, accountants use something called a journal entry, which would record all the transaction effects. So a journal entry is basically an entry of one event. In this example is the stock issuance event. So this is one entry, okay? The structure of the entry is basically looking like a table. You will see the first column listed all the accounts. The second and the third column says debit and credit. We'll talk about debit and credit in the future, basically in the next slides. So you will see that there is the account name and then increase assets, increase stockholders' equity and such. And you would also see debits is always above credits, okay? You always write debit first, and then credit will follow. And the credit accounts would usually indent it to the right a little bit compared to the debit, so people know this is a credit, all right? So this is the structure. So in this example, you would see that when Chipotle issue new stocks, cash increases. Now, when cash increase, accountants create a rule. Now, remember, debit and credits, they are not necessarily mean increase or decrease. These are just rules. So accountants create a rule that when asset increase, when cash increases, it increases in the debit side. So cash increase by $17 would be recorded as debit cash for $17. Similarly, when common stock and APIC stockholders' equity increases, we would use credit side to record the increase. So 1 and 16 are on the credit side. Okay, so if you are an accountant right now and you're professional, when you look at an entry look like this, it basically can be deciphered to a statement that this company received cash for $17 and also issued new stocks in a par value total $1 and the premium is $16. So this entry look like a table basically tells you this type of information if you know the language. Alright, so now the most important question is that how do I know which account increase with debit and which account increase with credit? So this is the trick that I'm going to teach you to remember debit and credit. So debit and credits, as I said, they are just signs, okay? They do not necessarily mean increase or decrease. So you cannot say, for example, you cannot say, when I see a debit, it means increase. That is wrong. So for asset, liabilities, stockholders' equity, now we reworded it as owner's equity. It's the same idea because we want it to look like a word. So owner's equity, revenue and expenses. Now this reads like a lure, right? A lure. So a lure is like a sandwich. On both ends of the sandwich, accounts increase with debit. In the middle, accounts increase with credit. Now let's practice. So whenever you try to write an entry as a beginner, you want to go back to the transaction analysis. In the transaction analysis, it shows that cash increases by 17, right? So first of all, you ask yourself, cash, what is cash? Cash is an asset account. In Allure, it shows that cash increases with debit. Therefore, we know that we want to write cash on the debit side because cash increases with debit and $17. Now, if you go back to the transaction analysis, you will see that common stock and APIC under stockholders' equity also increased. And from Allure, we know that owner's equity increases with credit, right? So we want to write the increase of common stock and APIC under stockholders' equity with the credit side. Now, when you check your entry, pay attention. 1, you write debit above your credits. So you write debit first and then followed by credit. Also, debit always equals to credit. So your debit side has 17, your credit side needs to add up to be 17, which is similar to what we have in the transaction analysis. You want to maintain your equation equal. So you can see the left-hand side of your equation increase with debit, the right-hand side increase with credit. So you want to have your debit side and your credit side equal to each other. So you can see here, 17 equals to 1 plus 16. And there's no need to write the dollar sign. You don't want to write any dollar signs in an entry. Also, there's no plus or negative. There's no positive or negative number. Everything would be positive because you know debit and credit. Debit for asset account already means increase. And credit for stockholders' equity account also means increase. So you don't need plus or negative signs because debit and credit already tells you the sign or the direction of that asset or stockholders' equity. All right, one more example. Borrowing from the bank. So Chipotle borrowed $4 from the local bank, signing a note to be paid in 3 years. So it's a non-current liability and it's a financing activity. In this example, what did Chipotle get? Cash, right? Cash increases. What did Chipotle give up? It's basically an obligation to pay in the future. So notes payable, a note to be paid. So notes payable increases for $4. You would see your left-hand side equals to the right-hand side, $4 and $4. When cash increases, we already talked about it. Cash is an asset account. Asset account increases with debit. So debit cash for $4. Now we are going to write the credit side. A law tells us that liability increases with credit. So we know that when notes payable increases, notes payable should increases with credit. So we would debit cash for $4, credit notes payable for $4. Again, an experienced accountant, when looking at this entry, understands this entry or this table basically tells us cash increases and liability increases, both for $4. All right, so here is the assignment after this video. I would like you to review the Chipotle example in the textbook and try to figure out the journal entries for each transaction. Now, this is very important because in the textbook or the exam, there are only so many types of transactions that we are going to cover in this course. So I want you to review the textbook of the journal entries one by one, trying to figure out for each transaction how you would write debit and credits. And McGraw-Hill has a guided help video 2-2, which will also partially talk about writing the journal entries. All right, I'm going to see you in the next video.